Dear students, today we're going to work on portfolio management in Excel. It's going to be super fun. We're going to use exchange traded funds, also known as ETFs, and create an aggressive, a moderate, and a conservative portfolio. In this video, you'll learn how to troubleshoot and use a template, because a template is like one size fits all. So that means that you need to make certain adjustments, move things around. We're going to do some troubleshooting and some other good things that will teach you how to better manage an Excel spreadsheet, use templates, tweak it for your benefit. I hope you'll enjoy it. Cool. Today we'll start working on building a portfolio in Excel. The portfolio management of this fund will be focused on index funds, and we're going to actually use something called exchange traded funds, or ETFs. ETFs are a pool of investments just like a mutual fund, but in this case ETFs are traded just like a stock, where mutual funds is actually not actively traded. So when you buy or sell a mutual fund, you typically get whatever price it settles at in the end of the day. Now exchange traded funds, you can trade at any time during the day, just like a stock, and that's the benefit of it. The major difference between a stock and a exchange traded fund is that the ETF is a pool of a bunch of stocks. So for example, iShares US Industrial ETF mimics, in this case, the Dow Jones Industrial Average. My Excel spreadsheet has additional information up here, and that's intended to help you. So one, I have a link here for Yahoo Finance. We'll go to that website and I'll point out what information is available there that you can use. And we'll also take a look at Investopedia that has a nice web page on asset allocation. Now this box here is to help you collect the information from Investopedia, how an aggressive portfolio, moderate, or conservative portfolio looks like, because they have different weights to them. So an aggressive portfolio might have almost 100% stock, versus a conservative might be very much into fixed income. So you would just add the percentages here. Now what you need to do, and this is where arts meets science in this case, is that the artsy part is that you will on this side right here add whatever weight you want to have into your portfolio. I have also added a few equations that you used in the past, but some you haven't, but they're available in the book on the portfolio management. And some of these are, for example, expected return calculations that you might want to use when you calculate how good your portfolio is. Now let's clean this area up a little bit. We have aggressive, moderate, and conservative funds. We have an expense ratio in dollars. Now this is going to change depending on what kind of weights we have in our portfolio, but the expense ratios will not change. So we're going to just make it simplified by having an expense ratio next to conservative, and then copy the same column and put one next to moderate and aggressive. So let's do that. So what I'm going to do is I'm going to simply create some space here and move this over maybe like 2 spots. And then I'm going to just copy the expense ratio in percent and move that over to here, because this is all fixed data, and here's where you guys are going to play around a little bit. So I'm going to then move this one over there, and then I'm going to copy this column, copy, and then paste, and then I think I have to make some more space, and I'm going to move this over 1 spot, and then I just copy this one then here, right here, bang. Copy and then paste like that. Looks good. To not confuse ourselves, let's just merge these cells so it has a title above it, and then maybe we want to just add a nice little border around it so we know what is what when we are making calculations and stuff like that. So maybe we just put another nice box here. It's not necessary, but it sometimes makes it look a little nicer. Maybe I'll just add a nice darks there. Okay, let's go to the websites and collect some data. The first website that we're going to use is Yahoo Finance. And here you're going to enter the ticker symbol IYJ for iShares Industrial Average that I used as an example in this spreadsheet. It will first land us on a summary page that gives us some basic information, tells you what yield it has, the expense ratio. The next one we might want to look at is more of a picture. Here we can see the valuation changes. Here's our big Corona plague drop in the market. We can look how that looks like over a, say, 5-year period of time, and see that there's been other corrections in the market. And this is something you might want to play around with and learn about. Another part is profile, where it lets you know a little bit more about the style of investing this company has. And this is sometimes called the Morningstar boxes, where you have, in this case, a blended portfolio and a blend of very large companies. Here you will also have more information. Here's the expense ratio that they have on a category average versus the ETF specific. You might want to go to holdings and see the different types of sectors that this ETF is investing in, and some statistical information. Another part that you might want to look at is the performance, and it will look at year to date, 1 month, 3 months, 1 year, up to 10 years. And then they have year-over-year data that might be interesting to look at as well when you decide how you want to allocate your funds in your portfolio. Now, the risks here, the last section here, has all the statistical parts that you will grab. You can choose typically 1 year, 3 year, 5 years, 10 years. I would probably recommend maybe a 3 or 5 year, just because we just had a correction, and you don't want that to overpower how your portfolio is invested based on the weight. So you might want to look at what the numbers are on the traditional history versus on a short-term perspective. The other website we'll go to is Investopedia. They have a good section on portfolio management, how to achieve optimal asset allocation. It's an excellent article. It talks about large cap, mid cap, small caps, international, emerging markets, money markets, fixed income, and so on. And depending if you are an aggressive or a conservative investor, that has to do with your risk aversion. You want to invest differently. So typically very safe investments will have very close to risk-free rate of return, which is typically the 10-year treasury, government treasury. But then as you add risk, you should expect more return. A positive alpha would be that you take, for example, the same risk as this blue chip suggestion here, but you actually get a positive return with the same risk here. And whatever this alpha is, if it's positive, is up and beyond what you will get at the same risk level. And now you can have a negative alpha, which means that you're getting less return than you should have. So once you go down and look at everything, you might have a portfolio that says, 70% of your portfolio should be in equities, 5 to 10%, 15% should be in cash, and the other 15 to 20% should be in equities. So that's a conservative portfolio. There's different rules of thumb. Some would say that you should have your age in percent in fixed income, which means that you would have it between cash and fixed income. So there's different ideas of how to do this the best. But here you'll be given all kinds of suggestions. Other web pages will have their discussions on how to allocate your portfolio. Once we have grabbed all the data that we want from the web pages, we enter those in these little boxes, depending on how we want to adjust our aggressive, moderate, conservative portfolio. This is just a good memory for us to put that up, that is what our portfolio looks like. Then we will add information around here that is comes from Yahoo Finance. And then after that, we're going to make our different weights. So once we looked at Investopedia and looked at what should an aggressive, moderate, conservative portfolio look like, now this is the interesting part. This is where science meets art when it comes to finance. And so some people will say that aggressive should be, say, 70, 20, 10, or 100% for equities. Other would say that moderate should be like 50-50 and then a little cash, and conservative should be maybe a little bit of stock and then most of it in fixed income and a little bit in cash. All this, there's no real right and wrong. There's more of a scale left to right of what is a good example. But this would just give you a nice little profile for how your portfolio is going to look like. So we can have a nice little background color, say that we put it as a little orange behind there, for example. And then maybe we want to highlight how our the amount of money that we're going to put in this fund. This is going to be the 100,000. Now, once we grab the information, we start putting that in under the different ETFs that we have. But before we start making changes here, there's one thing we have to adjust. So when you have a template, it's not always perfect. That means that you have to make certain changes. In this case, we might want to change and move the shares held and over to each part of our portfolio, an aggressive, moderate, and conservative. That means that we have to make some room. We might want to cut this out and then plop this in here in between. But before we do that, let's create some space. So we can probably just mark the cells we want to move, and let's just move this over, say, one spot. And it says you can't do that. It gives you a warning signal. And naturally, you'll try that over and over again, and not until you realize that you have to unmerge your text cells that you want to move. That's when you're allowed to start moving cells, because otherwise you get this frustrating error message and you might not know what's going on. Voila, there it worked. So let's just grab the shares held here and then throw that over there, and naturally you have an ugly little box here. So let's just readjust this one box and say no borders, and then we're going to add all the borders back to it. And now let's merge the cell of these three, and that way we know how these all work. And then we're going to copy this structure for the other ones as well, but I'm going to not focus on these right now so much because they will work the same as the aggressive, especially when it comes to the calculations. Another column that you might want to move is the market value, because that would be the market value of that portfolio. Yet again, a template is there to be adjusted. So we would simply take away the borders, add the borders, and make this look nice yet again. And that's how templates work. You have to tweak them and make them look nice. So once we believe that we're happy, we take the boxes that we have and then we move them. And guess what? We totally forgot about unmerging the cells. And so that means that we'll just redo the whole exercise again. Now we should be able to move it. It works. And then adjust the column size. And now let's merge the cells. And it seems like I accidentally deleted the information. So here we're going to call this aggressive. And a good thing to do is go up to review and double check your spelling, and you can ignore certain things, and if you find one that is misspelled, you just change it. Spell check is okay. You're good to go. Now let's make some nice calculations here. So I don't like this fat line here, so I'm going to go back and go to no borders. Then I'm going to add all borders, and then I'm going to add the fat border all around this. Now I like the way it looks. So now I'm going to show you some of the calculations you need to do. Some things are assumptions, like the weight. So I'm going to just look at the aggressive weight right there. It's 70%, say, and we have 1, 2, 3, 4, 5 roughly equities, and then some European and some emerging markets. I'm going to just say 10% here. Just be happy with that. Now, the expense ratio, that's a constraint on that and that, but also has to do with how much money we have in this portfolio. So let's just make a simple calculations here. So we'll start with an equal sign, and then we're going to take 100,000 times that weight, which means that $10,000 is what we will invest in there. However, that's not what we're going to pay in fees. We're going to pay roughly 0.5% in that and for this holding, so that's $42. Now the amount of shares held is equal, naturally, the 10% times the 100,000, which means that that should give us the 10,000. Or did I do that right? So something went wrong there. So the 100,000 times the weight, which gives us $10,000. Now we have to add the parentheses here, so we can divide it by the stock price, in this case $118. This gives us $84.14. Now this is going to be shares, so that's not dollars. So we have to format this cell, which means that we right click, get this box up and format cell, and then we left click and call it just a number, and then click OK. Now the market value will naturally change given the stock price. So we're going to take the number of shares times the stock price, and we will get a market value. So tomorrow, when the stock price has changed, this should change as well. So if I do that $200, then this price should change, and it doesn't. So when you realize that you have a mistake, this is when you go up and look at formulas and look at all the different spots that the cells that you're using, how they're related. So here we can see that the 10,000 is related with that one, that's related with that one. Let's move it over to the shares held, and then look at the dependence again, and then we realize there's somewhere here there is a situation where something goes wrong. So there we go, and that means that this number remains the same regardless of what I put in as a current price. Now the reason for that is that I'll go this slower. Is that this number uses this number to create that number, which means that it's a function right here. Remove. And that's why templates are not always perfect. You have to modify this and try to learn how to troubleshoot. So that means that this one is dependent on this, and we're using current price, and then the current price changes. That means that we have to add a column called purchase price. That's what you typically have on your trading accounts. Shifts right, yeah, sure. So, and then we'll have to just adjust this, and then we'll call this purchase price. And as usual, you always want to double check that you have spelled everything right, and you do that under review on ABC spelling. And you ignore that one, and you ignore that one, and you ignore that one. It's actually correct. And it did everything right, and so there we go. So that means that I'm gonna just, oops, I don't want to take that away, but I want to make sure that I have the $119 here, and the market value will be based on this, but this one is now going to not be based on the current price, but rather the purchase price. And once we have that adjusted, we have insulated the number of shares that we bought, and that means that the market value will increase. And naturally, take a look at this. It all got messed up once again. So we'll see if we can just move that around, and we can't. So let's just go up to home, unmerge these cells, move the cell right over, add some little gray there and try to match it, and then again merge the cells, so we got that centralized. Now we have all of these things calculated, and now you just have to do that over again, and I will just move this over like that. So for these, for the moderate and conservative, you'll try to match this part, and you'll add the purchase price as another column. And once you've done that, all your calculations should work really good. And then you can make other calculations. All these things have changed down here, so you can probably delete that and then just see the market values, the sum equals sum to whatever the market value of your portfolio is. That will change day over day. Now in this case it ended up being percentage points, so sometimes it works to just switch this over to dollar signs. If that doesn't work, you click in the box left hand and then format cells and pick if you want a current accounting or currency, and then you pick how you want it to look like, and then click OK. I hope that you have enjoyed learning how to edit a template, troubleshoot when something goes wrong, make assumptions, spell check, merge and unmerge cells, and do things like format cells when it's either dollar signs or percentage points, or should be in general, or should be a text box or something like that. If you enjoy working on templates like this, you might want to work as a financial advisor, or strictly on this side, be a portfolio manager and work more on this kind of investing, or maybe even actuary science, where they also do things like this. I hope you enjoyed learning how to create a portfolio. It will better help you manage your own money, which you will have to do at some point or another, or you just outsource it to someone else. But that means that you're paying someone else to get rich on your money, and you might want to keep more to yourself. Who knows? Anyway, until next video, please like the page and this video if you like it. Be good, study hard, and make sure that you make a difference in your and other people's lives. See you soon.